recent market pullback, the 10% correction, and what you can do about it. So my name is Imran. I'm the financial writer here at Stashaway. If you've read any of our weekly newsletters, I'm the one who writes them.
And I'm Ken, the country manager of Stashaway Malaysia.
Yes, so let's get right into it with our first segment, Invest It. And what we saw with the correction, the 10% drop in the S&P 500.
Why do they call it a correction? It's such a
Because
a psy-op, right? It's saying like it's returning to valuations that are more sustainable. So it's not a drop.
It's not a drop.
It's not a decline. It's correction. So were we wrong before? Can we correct up?
You'll correct up again. And it was quick. Only 3 weeks. It only took 3 weeks to drop. If we look back in 2023, the correction that happened then, it took 3 months to unfold.
When was it?
A 10% drop. I'm not sure.
The last one.
The last one in 2023.
In 2023.
But which month, I'm not sure. So that's probably why it feels a bit jarring, right? And especially if you are in the moment and you see all the news headlines, so it can be a bit scary, right? And here's another thing that's unusual about this correction, Ken. It's been 343 trading days since the last correction. Okay?
Okay.
So that's
So
like
we've had a really smooth ride.
just a smooth ride upwards, mostly.
Last year we had 70 new all-time highs, remember?
Yes.
We were
So
counting.
it was, yes. And that number, 343, is twice the historical average in between corrections.
Oh.
So what's the trigger for this one, right? Well, we talked about it last week as well. We talked about it the week before as well. It's about tariffs, right? It's about tariffs and the trade wars that are happening, the uncertainty in US policy.
Yeah.
I think that's the main thing here, right? And markets, whether it's good news, it's bad news, that's fine. But uncertainty, that's something that markets really dislike. And so, but let's put it into a bit of perspective, right? Because after 2 strong years, like you just said, I would say many analysts might say that the S&P maybe in tech, the valuations were a bit rich already, right? So right now, NVIDIA is down 14%, right? During this correction. But over the course of 2 years, it's up nearly 7 times. Right?
Wow.
So, and NVIDIA is just a representation of the US tech sector. So, context matters, right, Ken?
Yeah, I think so. And that's why we are here, right? To give you a way of looking at markets in the way that is different from the financial news, because after all, the financial news is trying to have you be emotional and engaged and read its content, right? Clickbait you
That's
into
the business
into the content, right? And they do it in a few different ways. But if you are in our shoes, you would see actually that corrections are quite a common thing. It does occur from time to time. And there are a lot of reasons why they happen. Like you say, the current one is triggered by a trade war, which is going back and forth.
Yep.
It can also happen because of economic weakness in major countries like China or the US. It can happen because of inflation or interest rates. It could be also things like certain industries or certain asset classes going through some of its own volatility, shall we say. So we look back over the last 10 years and we found that there were 4 corrections apart from the one that we have just experienced. And actually the average drop of these 4 is around 13%. So from peak to the bottom, 13%, and it takes on average about 4 months to recover. But if you had invested at the bottom, just for argument's sake, right? If you timed it perfectly and you just waited 1 year later, you would be up on average around 25%. And 25% is actually a really significant number, because if you look at the 10-year annualized gain of the S&P, which is around 13%, this investing at the bottom and only waiting 1 year later is like double the amount that you would have from a yearly gain in the average year of the S&P. So while timing the market only works in hindsight, and we all know that the recovery happened because we are in the now, this has all happened historically. History rhymes. The investors and the markets find a reason to come back to investing and then recovering the losses that it has made. So this is why dollar cost averaging, which is something we talk about again and again and again.
Yes.
But I think normally we talk about dollar cost average in the sense that every month is no different, you should just go in. But because there are these corrections, and if you happen to DCA in this moment, it's as if you are dollar cost averaging during like an 11-11 sale or like a 12-12 sales, a significant sale, as long as you are in it for the long term. So dollar cost averaging is truly powerful. So that's one context, right? I also wanted to talk specifically about Trump because it's what triggered this current sell-off, right?
Let's talk about Trump.
So if you wanted some reference points, we are now dealing with a trade war, like we said, that's going back and forth, a lot of showmanship. If you look back at his first term, this is right out of that playbook because he's doing the same thing.
Oh.
And essentially, if we look back into what happened during his first term, we found that actually these trade wars result in short-term fluctuations. It can be small, like -1%, or it could be large, like -6%. But during Trump's whole term, on average, the market was up 16.7%. There was only one down year in his 4-year first term. So ultimately, Trump was good for markets.
Okay.
So just to recap, we look back the last 10 years, there have been some corrections like we're going through now. On average, they're down 13%. But if you had just invested at the bottom and waited 1 year, you would potentially get significant gains of 25%. And this is historical data.
Yeah.
And if it's triggered by Trump, we've seen this before. So I'm not saying don't be concerned, but definitely don't panic.
Yes. And I think the other point I wanted to talk about, since we're talking about Trump and the US, so it is a US matter, right? And I think that's why you want to diversify. That's a huge reason why you want to diversify in the first place, right? So for example, I'll give you an example. Last week, we saw the S&P was down 1.5%, but global equities, excluding the US, was up 6%, okay? And we're talking about things like places like Europe, right? And if you look at gold, which is, we all know it's a safe haven asset, right? So that, when there's risk, when there's volatility happening, people move to gold, right? So what happened to gold? It went up 11% year to date, and I think it broke the $3,000 US dollar mark already, right? So here's what you can do about it as well. If you are looking for something that you want to invest in right now, you can simply look in our app because we have something that's already ready-made, a ready-made portfolio for you. You don't need to think about what sort of asset classes to manage, right? Our general investing portfolio. If you open up your app, you press invest, it's probably the first thing you'll see, in fact. So I think perspective matters, Ken.
Yes.
Just to summarize
Absolutely.
it. If we look at things in terms of years and not the months and the days, because in the middle of volatility, of course it will be stressful. So let's take a little bit of a step back maybe. Okay, we have someone in chat. His name is Zhenhen_98. Hello, hi, big fan. Okay.
Of the show.
Of the show, yes. Closer to home. Let's bring it back closer to home, guys, with Real Talk. Real Talk is the segment where I trawl through the internet, specifically Reddit and Instagram, and looking for Malaysians discussing their finances. And recently, we talked about this, I think 2 shows ago, Ken, when we talked about EPF with their 6.3% dividend.
Yes.
Which was great, right?
Amazing.
It was big dividends.
Huge dividends.
Huge dividends. 2 weeks ago. And somebody was talking, right? It's a Reddit post, right? So they're discussing it, right? What asset category would you classify the EPF or your EPF retirement fund as? Stocks, unit trusts, bonds? This person is trying to work out their asset allocation. I think it's a great discussion, right, Ken? Because if you think about it, actually your EPF retirement fund, it's a huge part of your wealth, isn't it?
It is. And it's absolutely the right question to ask. Not enough Malaysians are asking this question. Everything you invest in, including the EPF, has exposure to some sort of asset class. Whether they package it in a certain way that kind of only shows you a certain kind of information, or they show you a lot of transparency. Either way, if it's an investment product, there's some sort of allocation to assets, right?
Yeah.
So it's the right question.
It's in the name, right? Investment.
It's the right question to ask because EPF is a fund. And it's important to know how this fund is managed because it's, first of all, your money. But because EPF is this retirement fund, you should understand the asset allocation so you can make investment decisions today because you can only access your EPF later on. So if you think about how significant the EPF, your contributions to the EPF is, you can also actively invest to get to the risk level that you ultimately want. Okay, so what do I mean by that? Every month you contribute something like 11-12% into your EPF and your employer contributes a similar amount as well. So you're essentially dollar cost averaging towards your retirement. And what is it dollar cost averaging into? Recently, because of the 6.3% dividend, we found out that the EPF will update you quarterly in terms of how their asset allocation is looking. So they gave us the 2024 asset allocation, which was 56% fixed income / bonds, real estate, like protective assets. So 56% essentially bonds, and then the remainder 44% equities. So that represents a very balanced portfolio, right? 56% bonds.
A bit conservative.
A bit skews a bit conservative, and rightly so,
Which makes
because
sense.
it's for your retirement. So now you know that a significant part of your wealth, it could be as big as half if you're near retirement already. It could be something around 30% if you're near the start of your career. Whatever it is, find out your EPF balance, and you know that asset allocation is something around 56% bonds, 44% equities, which is a balanced portfolio. Knowing this, instead of like actively trying to fix things, sell this, invest in that, sell this, invest in that, you know that EPF is already balanced. So you make choices, deliberate choices of how you want to invest today to get to a risk point that you want. Knowing that it's 56-44, you can invest 80-20, 80 into equities now,
Right. So
20% into bonds.
So your overall investments are pushing towards.
So that's why it's important, because people don't understand what's in their EPF. They tend to take too little risk, especially when they're young. They have a long-term horizon. There's so many investment platforms out there to invest overseas, to invest in different asset classes these days. They tend to play safe. Maybe some just FD. But on the side, you have things like EPF. On the side, you have things like ASB, which is also a similar asset allocation to EPF. So you end up playing it too safe, and then you have too little for your retirement. Because you have this big, ballast, which is your EPF, you can actually afford to take more risk than you would think. So ultimately, invest to reflect the risk you want to take, and definitely factor in your EPF.
Wow. Okay, I love that. And I think I was thinking about this as well. It's sort of what we said before. So because you can take that risk, and then you can achieve those returns higher potentially. So because you have that longer term time horizon. Okay. Thanks for that, Ken. And we'll move on to our final segment, Ask Away. And we have a question that's really quite relevant given the earlier segment when we were talking about corrections. We have a question from our client, and they ask, will my money go through significant loss or drop drastically if I invest with Stashaway?
So when we saw this question, it strikes me as a very, very basic question, a very fundamental.
It's a very fundamental question, and I think probably maybe for somebody who's new to investing as well.
Yeah, exactly. And it ties into what we talked about earlier, which is the corrections. Also ties into things like EPF. So because we live in Malaysia, if you only invested in ASB, FD, and you contribute towards EPF, you might get the sense that actually investments works where you put in some money every year, magically in a positive number, they will give you a dividend. You give you a rate that you can kind of see your money grow steadily. But actually that is only relating to those kind of products, retirement products, cash products, right? Why does something go up and down? Why does something fluctuate? Why is something volatile? It's because of risk. Something goes up and down because if something is listed, let's say like a stock or an index, that thing changes every day based on all of the investors' expectation on it. Today, people are bullish, then it goes up. People are bearish or they feel negatively towards something,
it's the market price,
then it goes down. Today's price is the market price of what they think that thing is worth. So that's why it goes up and down. EPF may have packaged everything and managed everything so nice for you,
And then you just see that one
and
number.
then you just see that one number.
Yeah.
Or cash, you don't take any risk, so you don't see any ups and downs. But if you want to aspire to more returns,
Yes.
you need to be comfortable with the risk. You need to accept the risk. Okay, so with the short term, like we talked about, daily, there's a lot of fluctuations. Things move markets. People have different strategies. Stocks and different asset classes and indices all go in different directions.
Yep.
But if we focus, let's say, on the S&P 500, which is equities, of course, something that does go up and down in the short term and in the long term, let's look at what those results are. Okay, so I actually took quite a long view. I went back 24 years, which is over 2 decades, right? So since 2001. So if you look at the S&P since 2001, 24 years, right?
Yeah.
There has only been 5 negative years on calendar years, right? So there's only been 5 calendar years.
Okay,
which
for the
means-
S&P.
For the S&P 500, which means that there's 19 positive years. So all of this shakes out to average 10% each year. Okay, so I use this number and this long time period because it's also good to compare to, say, something like EPF, which does take 20 years for your retirement, 25 years. With EPF, you get around 5 to 6%.
Yep.
If you want this more return, right?
Yep.
If you want to deserve 10%, you need to accept the short-term fluctuations. So get educated, learn about different markets, asset class, put a little bit of money into Stashaway, learn, receive our communications, and then ultimately you will see that actually it's not about will I put money into Stashaway and will I lose a lot of money? It's about understanding why your portfolio is making positive gains or negative losses, and understanding the drivers behind it.
What you're investing in, how it works, etc.
And ultimately, if you are patient enough, and I just told you about these 20-year returns, on average 10%, for the equity markets, it's something that you can also take into consideration, because if you're invested with us for the long run, you will also make gains.
Yeah, and that 10% it's annual, right?
It's
so
annualized,
it will
yes.
compound, it will compound, it
Yes,
will compound.
yes.
Okay, so and I just want to say, just to add on to what Ken said, one thing is that perhaps not everyone has the same risk tolerance, right? So the level of risk you're comfortable with, that's fine also. And that's also why as I was talking about earlier, with the general investing portfolios, even with something that diversified, you can still adjust the level of risk you want, right? If you can add a little bit more bonds, you can add a little bit more stocks to skew to be a little bit more aggressive on that risk-taking front, right? Okay, but I think the point of it is that, just to summarize the whole show, because I think all of these segments are quite interrelated, it's about having that long-term view, that 20-year, that the goal that is 10 years away, 20 years away, right? So very simple. All you have to do, you just Google the S&P 500, and you click the maximum time frame of the graph. And you tell me if you can see any of the corrections in that line, because you can't. It's too small in the grand scheme of things, right? And that's the point, right? You just want to stay invested to build
zoom
wealth.
out.
Yeah, and zoom out. Yeah. So thanks, guys. Another comment. I cannot pronounce this. A series of letters ending with 11. Interesting. Thank you. Okay. So that's all for today, guys. Thank you for watching. We'll see you next week. Same time, Monday, 6 p.m. And if you want to be notified of our show when it goes live, you can simply subscribe or follow this channel. So thank you. Bye-bye.
Bye-bye.